Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 66. On today's episode, we're going to explore the topic of investing like a woman. Academic study after academic study shows that women tend to be better investors than men, and I'm going to break that down for you. We're also going to talk about this horrendous September that is finally over, thank goodness. What a painful month, year, quarter this has been. So we'll discuss what has to happen before this maybe makes the turn for the better. So I hope you'll join me, get your mind right, and let's get to work. All right. Well, welcome back to the program, everybody. Appreciate you joining me today. I know many of you are wanting to know a little bit more about the Berlin Marathon, the reason I've been absent for the last, week or so. I'll do a mini episode kind of discussing the Berlin Marathon. You can look for that later on this week. But today I wanted to talk about just what a horrendous September this was for the market. So historically, I think I mentioned this a couple podcasts ago, that September is historically the worst month of the year for the stock market. And this September seems to be especially bad. The NASDAQ was down 10.5% this past month. The Dow Jones was down 9% this month. In 1 month. Do you realize, that's bad for the year, but to do it in 1 month is just, oh my gosh, just especially painful. And so this ends up being the worst month for the market since March of 2020 when COVID hit. And it's actually the worst September for the Dow since 2002. So worse than even during the financial crisis. So, what's going on here? Obviously, the Fed raising interest rates is a big piece of that, taking a hard line, saying they're going to continue to raise interest rates until they see inflation come down. But that has also pushed the 2-year Treasury, 10-year Treasury up. The 10-year Treasury sits at 3.7%. The 2-year Treasury is at 4.3%. So you have an inverted yield curve, and an inverted yield curve means that your ability to generate a return on those assets is actually better during the short term than long term. So historically, you would think that the 2-year Treasury would offer a smaller return than the 10-year, right? Because you're locking your money up for 10 years versus 2. And so when this inversion happens, it's usually during times of the Fed raising interest rates at a super fast pace, which they are definitely doing. And so those inverted yield curves tend to foreshadow recessions, right? And like I said, it's not like somebody comes out and, rings a bell and says, "Oh, we're in a recession." Normally they come back months later and say, we started this recession here. So a couple things going on with this. Obviously, the inflation, the Fed. You have China's COVID policy, their zero COVID policy as far as locking cities down. You have Russia, Ukraine still going on, and it just looks really, really nasty out there. And most people are willing to just say, "I'm done. I'm done with this." And it's hard to be optimistic when you look up and you see losses day after day. I was really surprised on Friday this past week. Friday was actually doing pretty well. And then the last hour of the day, the market just tanked. The Dow ended up down 500 points, but I think before the last hour, it was only down 100. And so you see traders that are not willing to even hold over the weekend because they don't know what news is going to come out, what might trigger the market to decline on Monday. So it's definitely very, very scary out there. You have to know what you're buying. You have to buy in small increments. Even for me, when I'm making trades in the client accounts that I manage, I'm buying 5 shares, 10 shares, whatever it is. And so I look, I get this S&P oscillator, which tells you if the market's overbought or oversold. And we have been very oversold for the past couple of weeks. We actually hit minus 13 on the oscillator this past week. The last time I have seen that is 2008. And so at that point, when the market is this oversold, you just got to be willing to go into the fire a little bit and pick up some shares of something that you are willing to own for the foreseeable future. And I say that because, these bear markets, they're extremely painful. And when you look at them on a chart, you see it come down and then you see it come back up and you say, oh, I would have been able to ride that out. But that's not how it feels when you're going through it on a daily basis. And so you have to really be able to remove yourself, kind of think about longer term, 3 years. What's something I'm really going to be happy I bought 3 years from now when we've kind of made it through this mess that we're in. And really this year, there's been no places to hide. I mean, even gold has been down. I mean, just every asset class, worst year for bonds in almost 100 years or over 100 years. And so really, when you have a year like this, I mean, you're just like, okay, how am I going to set my portfolio up for the future? And definitely putting your head in the sand is not a good answer, even though we all want to do that for sure. So today's episode, Invest Like a Woman. Where did I come up with that? There's actually a book titled by that. I haven't read that, but I've done a lot of data or research on behavioral finance, and it's one of the topics that actually keeps coming up in some of the academic research. And so I wanted to share with you some of the tactics, the reasons for this, and just kind of have a discussion. There are two academic professors, Barber and Odine, that kind of made this famous in the late 2000s, early 2000s, and then people have continued to look at that data and kind of redone those studies, and they keep, the results keep coming back the same. And so, and just with my client base and dealing with female clients, male clients, I've seen it firsthand over the last 15, 20 years. It's definitely a different reaction based on who you're dealing with and the market, market turbulence, if you will. So I'm going to share that with you, and then I'm going to share a way for you to look at stocks, one measure you can look at stocks with to be able to determine what is their volatility index. So I'll share that at the end for you, but let's dive into this. Let's start investing like a woman. So as you can imagine, there's the couple traits that really help women outperform are, number one, easily is patience. Just naturally much more patient. They also trade less, significantly less, and I'm going to show you those numbers in just a minute. And they are much more, they're planners, they're steady, they invest even during bad times. But really, the patience and trading less often are two of the main things that allow women to outperform men. And so, Warren Buffett has over time always said it's more about temperament than intelligence. And so being more patient, not trading as often, men tend to be much more overconfident. So there is an overconfidence bias that where you basically are, men will tend to go against the grain. They think that they have, some kind of intellectual advantage or some kind of advantage that allows them to make better decisions, and their trade is going to work. So the studies show that female investors tend to be patient rather than impulsive. They're realistic rather than overconfident, and prudent rather than reckless. And so they tend to think longer term. They take less risk, and really just kind of allow things to happen much more naturally. And so Barber and Odine did a study called Boys Will Be Boys, and found that men tend to trade, listen to this number, men tend to trade 45% more often than women. And single men tend to trade 67% more often than women. So if you're young and single and you're a man, that is a recipe for definitely being hazardous to your wealth as far as over trading is concerned. Right? So, that's just a massive, massive number of more trades. And so even for me, like for this year, like I basically set a goal to try to not make sell trades. And I think in my personal account, I've made 2 sell trades the entire year. And, if I can get down to 0, that would be great. Warren Buffett says his favorite, holding period for an investment is forever. And one of the things that he shared years ago that really stuck with me is that he said that he would have more money today, and he's got a lot of money, but he said he would have more money today if he would have never sold anything, which to me is a shocking statistic. And he said the reason is because, yes, he would have had some of his investments go to 0. There are some that he would have lost money on, but there are far more that would have done much better that he sold out of them too quickly, and they would have done tremendously well over the years if he would have held on to them, and it would have more than made up for the ones that went to 0. And so, this thinking that we're going to be able to do better, that we're going to have, this overconfidence bias really tends to hit male traders over and over and over again. So one of the other things that was interesting is Vanguard analyzed the retirement accounts of 2.7 million customers during the financial crisis of 2008 and 2009. And what they found is that women remained calm with their investment accounts. They didn't panic and they stayed the course. And many of the male accounts, they saw that they were selling their stocks and locking in losses at the worst possible moment, and that they missed out on the gains when the market eventually turned around. And so you see this happen again, and we'll see this. This study was redone by Fidelity, and I'll talk about that in just a minute. But there's also Jeremy Siegel, a famous professor from Wharton, discussed this as well. And he says that, when you sell out, right, when you sell out, you got to be right twice. You got to be right when you sell out and it drops, and then you got to be right when you get back in and it goes back up. And so he's done studies on this. He did a study in 1990 on this, which is when he really became kind of famous for it. And then he's actually redone it this year. I think they're going to put the book back out there. I'll get you the name in just a minute. But what he found is that most people, when they sell out, you feel good initially because the pain is over, right? So if you sell out today and the market's down tomorrow, you feel smart. But then if the market goes up, what the studies show is that most people don't actually get back in until the stocks are above where they sold them. So if you sold the stock at 20, it goes to 15, and then it comes back up, you feel comfortable again, and then at 21, you get back in. And so you don't actually do what you say you're going to do. And so that becomes a major catastrophe for your investment performance over time. And so Fidelity looked at that Vanguard study that was done over those couple of years, and they said, okay, well, we're going to do that over a longer period of time. So Fidelity followed that up, and they looked at accounts from 2011 to 2020, and that covered 5.2 million customer accounts. And these are ones that there was nobody was talking to a financial advisor. These are their retail customers. They're not working with somebody or working with a professional. And sometimes that doesn't even help. But anyways, what they found is that female customers traded half as much as male customers. So again, that kind of sticks with where they had. And that alone, that not trading as much, that Barber and Odine that I've shared with you earlier, they did a study called Trading is Hazardous to Your Wealth years ago, and found out that individual traders who traded the most usually underperform the market by 6.5 points, 6.5%, because they traded too often. And so then that study, The Boys Will Be Boys, where they talked about overconfidence and over trading, saw that women tended to trade or tended to have better performance of 1.72% a year, simply because they didn't by as much. And then if that was on average, and then compared to the men who traded the most, they beat them by 2.65%. And I know that doesn't sound like a lot, but when you look at that over a 10-year period of time, it's quite substantial and can be, hundreds of thousands of dollars. And so when they're looking at this, they're trying to figure out, okay, so what's the big difference? Obviously, men and women are more patient. They don't trade as often. And so what ends up happening here, and really it comes down to this neurologist, William Bernstein, who showed that it really is about testosterone. And the fact that testosterone decreases fear in men, it increases greed, and it very much contributes to overconfidence. So good for, and he actually talks about this. He says, hey, it's great for muscle mass and reflex time, but it's terrible for your investing, your investing habits. And so, if you're greedy and you're taking on too much risk, it becomes a problem. And you really have to think about, the things we've talked about over and over again is it's okay to take risk. You just have to understand how much risk you're actually taking. And that book that I mentioned on Jeremy Siegel, it's called Stocks for the Long Run. It actually comes out in a day or two. I mean, this isn't a sponsored post or anything, but they're doing the 6th edition because they keep, the data that they came up with, they keep letting the years go by and they keep checking it against the data to see if it still holds true. And as far as I know, based on the interviews I've seen, it does. Trading too often is a killer for your portfolio. And the problem is when the market is this volatile, it's really hard to just sit and watch your money drop, right? It is painful to log into your account every single day, see how much money you lose, and then not want to do something about it, right? We want to do something. What can I do? What can I do to make this better? How can I help prevent this? And so we want to take some kind of action when really we need to sometimes just sit on our hands. But that is very counterintuitive to what our emotions are telling us to do. And so based on my client base, right, I have a number of female clients that I work with. Every time the market's volatile, I've been doing this, 16, 17 years, whatever it is, professionally. Anytime somebody calls me and says, I want to sell out, let's get out of the market, I'm done with, let's just head to the sidelines for a little bit. It's always been a man. I have never, ever received that phone call from a woman. Never. And most of the time, if a woman, calls me, a female client calls me, she's wanting to move more money over to invest while the market is low. It's really uncanny. And, when I started doing this research 10 years ago, looking at behavioral finance, it's one of the things that started, that I started to notice. And really, all the things that I've done behavioral finance wise, I mean, yes, it's great to know it, but it's actually impacted my personal trading philosophy, how I manage money. I think it's been more beneficial to me than it has been for the people I serve. Because I think about these things, and sometimes, the best thing to do is just stick to the course, because the reason that you invest in a company is because you think it's going to be a good investment. Right? Nobody buys a stock and says, man, I hope I really lose a lot of money today. And so if you're buying good companies, and I'm not talking about the high flyers, and I'm not talking about, crazy, investments that you can do that have a lot of speculative risk, but I'm talking about good, solid companies. Their earnings, how much debt they have, what the prospects look like. I mean, obviously the economy goes, it oscillates, it goes up, it comes down. But one of the things that you can do, and I mentioned in the beginning, is how do you tell what the volatility aspect of a company is? Well, if you go to finance.yahoo.com and you look up any stock, it's going to tell you what its beta is. And this is a good reminder of what beta is. And that is, it's kind of it's not a perfect measurement, but it measures the volatility of a particular stock, an individual stock. So the market as a whole has a beta of 1. So a beta of 2 would mean 2 times the volatility. A beta of 0.5 would mean half the volatility. So for example, if the market goes up 10%, if you have a stock that has a beta of 2, you would expect it to go up 20%. If it was 0.5, you would expect it to be 5% going up. Now, conversely, we might as well flip that because it's been a negative year. So if a stock goes down 10%, you would expect a beta of 2 to go down 20% and a beta of 0.5 to go down minus 5%. Boy, it's always tricky doing numbers through a podcast. So you can go through and you can look and see if the companies that you're investing in, do they have a low beta or not? So are they going to be less volatile than the overall market? So that's one measure that you can use. And so normally these are based on a 5-year, they're based on a 5-year trading habits. So they look at how these companies have performed based on every single month for 5 years. So if you have a new company that hasn't been around 5 years, you might not have a beta reading. But if we go look at like Apple, Apple's a 1.23. And if we look at AT&T is going to be 0.61. If we go look at Walmart is 0.53. So, these might be businesses that don't outperform, but they're also going to weather the storms a little bit better than the ones that get kind of kicked around. And so, it's also, this is the kind of market that if you buy something, you have to make sure that you're willing to hold it and that you're maybe willing to invest a little bit more in it at a later time. So earlier in this podcast, I told you, I'll buy 5 shares, 10 shares. I will buy small amounts for people and for myself on the expectation that if it drops 5% more, I'm going to buy a little bit more. And so you have to be disciplined. You have to be patient, right? Investing like a woman. You got to be patient. You got to be disciplined. You have to make sure that you are thinking about the long term and not trying to control too much of the situation. There are too many things that are outside of your control, but you can control your emotions, you can control your habits, and you can control not trading, fighting the urge to not trade. So just think about all these things and, absorb them into your trading patterns, or at least start the conversation of working with somebody who can help you keep your emotions in check, because it really is about that when you have these painful months and these painful weeks where it feels like it's never going to end. So I appreciate you. Thanks for listening to this. I hope this helps you, and I will see you next time. Thanks, everybody.